Good evening. Tonight we're looking at the gap between Wall Street and your kitchen table. This is the 8-hour workday with Rex Haymarket, where every crisis somehow becomes your bill and their bonus. Tonight, the stock market is smiling. The S&P 500 closed at an all-time high. The Nasdaq hit a record. The jobs report came in stronger than expected. The unemployment rate stayed at 4.3%. The analysts exhaled. The charts glowed green. And yet, outside the studio, normal people are standing in grocery aisles doing emergency mathematics with eggs, rent, gasoline, insurance,
and the sick little balance on a credit card. So tonight's question is simple. How can the market be fine while you are not?
The market is not necessarily lying. The jobs report is not necessarily fake. The economy is not necessarily collapsing. The problem is worse than that. The official economy may be telling the truth. It is just answering a different question than the one normal people are asking. Wall Street asks, are profits holding? Are margins protected? Are investors still buying? Are rate cuts coming eventually? But households ask something else. Can I afford rent? Can I fill the tank? Can I survive one medical bill, one missed shift? That is the split-screen economy. One screen measures asset prices, the other screen measures survival. America is not out of productive capacity. People are still working, the country is still capable of building and shipping. But capability is not the same thing as distribution. A country can produce wealth and still distribute stress. A stock index can rise while the people under it sink deeper into debt. That is the warning. Everything is being sorted upward. Stocks are not paychecks, they are claims on future profits. And profits can grow for many reasons. Companies can sell more, they can raise prices, they can automate, they can buy back stock. That is not always evil, but it is always a mechanism. From the market's point of view, the perfect consumer is not a comfortable person. The perfect consumer is a person who keeps buying, with cash if possible, with credit if necessary. That brings us to the bridge between the two economies, debt. The Federal Reserve's latest consumer credit report showed consumer credit rising in March at a 5.8% annual rate. Revolving credit, the category that includes credit cards, rose even faster. That is the part that should make you sit up. One is confidence, the other is pressure wearing a fake mustache. Credit card balances rise like a stock chart. And this is where the phrase resilient consumer gets a little dangerous. Because yes, households are resilient. They are also cornered. People skip the dentist, they delay the car repair, they pay one bill late to keep another bill current. They buy the cheaper brand until the cheaper brand is not cheap. They take the extra shift. They move back in with family. They use buy now, pay later for groceries and tell themselves this is just one bad month. Then the month becomes a year, and the year becomes the new normal. But from high above, it can all look like strength. Now the next piece is inflation. In March, energy prices jumped sharply. Gasoline rose more than 21% in 1 month. Gasoline is the price of getting to work. It is the price of delivery. It is the price of moving food. It is the price of running parts of the supply chain that eventually become the price of almost everything else. When energy spikes, the pain does not stay at the pump, it travels. This is why normal people are not crazy when they say inflation feels worse than the headline number. Your bill is personal. The University of Michigan reading fell to 48.2. It says, people do not feel like the official story matches the life they are living. Economies are made of trust. When that trust breaks, people behave differently. They spend defensively. They stop believing institutions. They start looking for someone to blame. And if the system does not explain the mechanism honestly, someone else will explain it dishonestly. So where is the optimism here? This is fixable, not with a slogan, but fixable. So the answer is not to hate the market. The answer is to stop pretending the market is a complete measurement of national health. A record stock market is useful information, but it is not a rent receipt. It is one dashboard, We need more dashboards. A serious economy would measure success by whether wages outrun basic costs. A serious economy would treat housing as infrastructure, build more of it, stop letting scarcity become a business model. A serious economy would treat energy resilience as household protection, less exposure to every geopolitical gas station jump scare. A serious economy would enforce competition, so companies cannot just raise prices because everybody else is doing it too. A serious economy would make work pay enough that credit cards return to being tools, not life support. It would ask whether productivity gains from technology are becoming shorter hours and more stability, not just larger margins. But here is the warning: if we do not change the dashboard, we will keep mistaking asset inflation for prosperity. Once people stop believing the economy can work for them, they do not simply become sad, they become volatile, they become angry. They become available to anyone with a scapegoat and a microphone. A legitimacy crisis at the checkout counter. The goal should not be to crash the market. The goal should be to build an economy where the market can rise and normal people can breathe at the same time. It requires asking better questions, not just, how did the market close? But can wages carry rent? Can families absorb emergencies? Because if the answer is no, then the stock market is not measuring prosperity. It is measuring distance between owners and renters. So the next time someone tells you the economy is strong, ask them which economy they mean, the one in stocks or the one due on Friday. Like and subscribe to Clock In. Mind the static, mind the spin, and mind who profits. And click the video on the screen to keep going.
I'm Rex Haymarket. Mind the numbers, mind the narrative, and always mind who gets the bonus when you get the bill.